Hello and welcome back to Module 1 on bonds, and now we're looking at the very final topic in this module, and it's topic 7, the risks when investing in bonds. And we kick off with downgrade risk. So basically when you invest in bonds, you're effectively lending money to a company. And you're lending money because you're expecting a coupon payment and your money back at maturity. So you want to make sure that whoever you're lending money to is credit worthy, you know. So when you look at companies, their credit worthiness is basically determined by their rating, if they have a rating that's done by a rating agency. And it becomes a problem if they get downgraded, because then it means the company that you've lent money to is no longer as credit worthy as they were when you initially gave them your money. So that's a risk that you face during the life of a bond, that the company that you've invested in or given money to or bought bonds from gets downgraded, which means that they're no longer as credit worthy as they were initially. The next one is prepayment risk. So that's basically, if we take it from the perspective of the bond issuer, where, for example, we had a callable bond we looked at in the previous topic, where a company could call a bond any time before maturity. So as an investor, you were expecting an annuity payment of coupons, a stream of coupons for 5 years, but then it gets stopped before maturity and you probably have to go and reinvest your money at less favorable rates in the market. So when a company prepays its debt, you as the investor, the risk that you stand is that it would happen at a time when the market is not in your favor and you have to reinvest your money at a less favorable rate. And then, of course, there's interest rate risk. In the previous topics, we spoke about the inverse relationship between bond prices and interest rates, meaning that when interest rates go up, bond prices go down, and vice versa. When interest rates go down, bond prices go up. So interest rate risk there, obviously interest rate fluctuations in the market will affect your bond prices, and that would affect where you could buy or sell bonds in the secondary market. So for instance, if interest rates go up and continue going up, bond prices will fall, which means that if you try to exit your investment by selling your bonds in the market, you'd be selling at lower prices. And then there is the risk of default, and that's looking at the perspective of the bond issuer, that there is the risk to you as a bond holder, someone who's invested in bonds, that the issuer that you've given your money to is either not willing to pay back your money at maturity or is unable to pay your money back at maturity. And then if they are not willing to pay or they're not able to pay, they are then in default. And obviously how that impacts you is that you would lose some or all of the capital that you've invested. So those are some of the risks to bear in mind. And as we know that, whenever you're investing in financial instruments, there would be some elements of risk, and it's all about being aware of those risks and trying to mitigate them as much as possible. And that brings us to the end of Module 1 on bonds. If you want more information or you want to go through some worked examples, please go on the website and download the training manuals that have more information and also more worked examples. Thank you.